Good morning, good afternoon, and good evening to everyone. I would like to welcome you all to another session of BONARD's Student Housing Market webinar series, today dedicated to our knowledge on the evolution of the student housing product and key market trends. My name is Filip, and I'm a product and development expert at BONARD, and it is my pleasure to guide you through what promises to be an engaging and informative session. Today's webinar will last approximately 25 minutes. And during the session, please feel free to submit any questions or requests via the Zoom chat at the bottom of your screen. My colleagues from research will do their best to respond in real time, but if not, we will definitely follow up afterward. Furthermore, this webinar is being recorded, and the recording, along with the presentation, will be shared automatically with all the registrants within a few hours. Now allow me to share my screen and kick off the presentation. Firstly, I would briefly introduce BONARD for those who may be less familiar with the brand. We are a narrowly focused living sector specialist with 18 years of continuous data collection dedicated exclusively to student housing and other rented residential asset classes. We cover more countries, cities, assets, amenities, rents, pipelines, transactions, yields, and other KPIs than any other provider, or even multiple sources combined. While around 70% of our in-house intelligence is available to subscription clients through the 24/7 access to the data platform, the remaining 30% resides with our team and within our aggregated company knowledge, built from hundreds of underwritings, CDDs, and asset and portfolio analysis. For context, we have advised on or reviewed more than 1,000 projects across Europe and globally. And this gives us a uniquely aggregated understanding of where OPEX, CAPEX, NOI, and yield levels typically sit by market, city, or asset type. While we never share individual and sensitive client data, this aggregated knowledge allows us to benchmark ranges accurately and identify optimization levers, something no other provider can offer at this scale or depth. Finally, all of our work adheres to RIC standards and is covered by professional liability insurance, providing added assurance in reporting, validation, and audit processes. These insights are drawn from extensive real-world advisory work for the clients you can see on the screen, as well as many others. Our client base spans leading investors, developers, operators, and lenders in the rented residential landscape. With this background, we are confident in our ability to provide expert, data-driven guidance that is realistic, justifiable, and capable of identifying gaps to unlock additional value. We operate as an independent, unbiased research and market intelligence powerhouse, always delivering an accurate story, not necessarily a pleasing one. And our only agenda is transparency, precision, and integrity in support of investment decisions. So without further ado, let's dive into the presentation and explore in further depth the student housing product and trends. To begin, I would like to highlight the core takeaway of this presentation. The student housing sector has transitioned from a basic necessity service into a sophisticated and institutional-grade asset class. From the 60s to the 80s, expansion of public sector provision in France, UK, and Germany created the initial scale and defined student housing as a non-private service. Starting in 1991, the UK pioneered the private PBSA model in Europe. The listing of United students on the London Stock Exchange in 2000 became the global benchmark event. It validated the model's viability, liquidity, and scalability, marking the true institutional inflection point. From 2010 onwards, we observed continental European integration. Institutional capital recognized the replicable model, triggering accelerated growth in Germany, the Netherlands, and later in Southern Europe. Since 2023, the market is mature and evidenced by the pan-European focus on ESG compliance and the amenity race. Competition is no longer about simply providing bets. It is about providing a highly differentiated, sustainable, and professionalized product. This historical context underpins our entire advisory approach. We provide the key stakeholders with the necessary long-term perspective to understand the capital flows and product development expectations of a matured institutional asset class. With this transformation established, we now examine how Europe's development cycle compares to the UK's earlier trajectory. The bottom chart illustrates a long period of minimal development prior to 2012, followed by an exponential surge in new bets. This acceleration was driven by proven investment models and institutional maturity in the UK, and ultimately leading to stable, high-volume production today. Continental Europe's development volumes from 2020 onward mirror the UK's 2010 to 2015 phase, signaling sustained growth, but still a comparatively early stage in the cycle. And based on the UK's historical pattern, Europe is approaching a major expansion period, including deeper penetration into secondary cities. This growth is supported by similar structural factors, such as increasing student mobility, persistent supply constraints, and growing institutional appetite. As development continues to scale, we also observe the same shift in ownership structure, a transition towards predominantly privately operated stock. In the UK, private stock grew from 22% in 2005 to 59% in 2025, demonstrating that once the model is validated, private accommodation quickly overtakes public provision. Continental Europe is following the same path, growing from 7% private share in 2005 to 36% today, a five-fold increase that reflects rapid market acceptance and development activity. Demand is steadily shifting towards professionally managed, high-quality private PBSA. This widens the gap between private and public supply and creates compelling opportunities for developers and investors. This shift in demand also reflects what students now expect from their accommodation, not just a bed, but a lifestyle-driven experiences. Operators such as Aparto, Canvas, ECLA exemplify this trend, offering high-quality modern PBSA with fully furnished rooms and kitchens. These providers consistently offer 10 to 11 amenities, supported by an all-inclusive rent model covering utilities, internet, cleaning, and 24/7 support, and creating a hospitality-style experience. This winning formula blends residential, student-friendly, and flexible working environments. In short, successful developers are creating communities, not just buildings. However, when we compare demand with supply, it becomes evident that the wider market still falls short of student expectations. In the chart, the dark bars represent student preferences, while light bars represent amenities currently offered. The largest delta is consistently in lifestyle and communal amenities, such as shared kitchens, where there is 83% preference versus 54% supply. And same goes for the gyms, where there is 80% preference and only 40% supply. These facilities therefore remain dramatically undersupplied, and the takeaway is clear. Amenities are no longer optional. They are a core factor in student decision-making. And therefore, the developers who successfully bridge these gaps capture higher demand and stronger occupancy. And when these amenities are delivered, the financial uplift is both immediate and measurable. This chart clearly establishes a direct linear correlation between the number of amenities offered and the achievable monthly rent for a standard studio unit. Schemes with fewer than 6 amenities serve as the baseline, achieving an average rent of 803 euros. Moving to the 6 to 10 amenity bracket yields a substantial 32% premium, pushing the average rent to 1,058 euros. And critically, schemes with more than 10 amenities command an impressive average premium of nearly 50% over the baseline, reaching 1,171 euros. The market is clearly willing to pay a premium for higher quality products. And furthermore, BONARD confirms that these upscale residencies maintain occupancy rates close to 100%, demonstrating that the demand is sustainable at these price points. This premium also is reflected in the evolution of the core unit mix. The institutional market has successfully tailored product design to meet the growing demand for privacy and independence, leading to dominance of self-contained studios. Across both Europe and the UK, this model is now fully established, while shared living spaces are increasingly marginal. So for developers, the private bedroom and bathroom must be treated as the core unit. Alongside quality and privacy, location remains the major pillar of student preference. Proximity to universities and good transport links is a top priority, highlighting that the success of any scheme starts with a robust site selection strategy. A successful PBSA development follows a clear two-step approach. At first, ensure a location in proximity to universities and transit hubs. Second step is layering high-quality amenities to capture the rental premium. So essentially, proximity serves as the foundational amenity, while product quality provides the uplift. Beyond quality and location, efficiency is increasingly achieved through scale. To drive operational efficiencies and attract institutional capital, developers across Europe are rapidly increasing the average scheme sizes, moving closer to the UK benchmark. Continental Europe has shown exponential growth in scheme size. The average size has effectively tripled from 83 beds in 2011 and is reaching 236 beds today, narrowing the gap with the UK. Larger schemes reduce per unit OPEX, justify investment in premium amenities, and deliver the economies of scale required for institutional grade portfolios. As scheme scale, location sourcing is shifting, and central plots are becoming increasingly scarce. Competition for central sites driven by heritage assets, regulations, and competing asset classes has redirected development toward well-connected suburban hubs. Today, the majority of the current development pipeline, 64%, is located in well-connected suburban areas, with only 36% of new projects centrally located. This is a clear response to rising land costs and limited availability downtown. The Greater Paris case study on the right illustrates the long-term structural trend in stock location. In 2010, nearly half the stock was central. By 2025, that figure dropped to just 32%, meaning 2/3 of the stock is now suburban. The market has therefore matured beyond the need to be directly on campus. The scarcity of suitable central sites also affects build methodologies. Demolition accounts for the vast majority, specifically 59% of new projects. This confirms that securing a clear greenfield site or finding a suitable convertible building is rare, particularly in core European cities. Often, utilizing an existing building is more expensive, mainly due to product match, regulation, and ESG certifications. The greenfield sites represent only 22%, highlighting the limited availability of untouched, well-located land. And brownfield conversions and refurbishments are also a minority at 19%, suggesting that the older buildings often lack the structural flexibility or location to be cost-effectively converted into modern PBSA. Given these constraints, it's no surprise that construction remains strong, yet still insufficient. While construction is robust across Europe, the activity is still concentrated and insufficient to truly close the widespread demand-supply gap across the continent. As you can see, the UK cities occupy 9 of the top 20 spots, including the top 2, which is Greater London and Manchester. This reflects the maturity and institutional appetite discussed earlier. Significant activity is also present in big European cities such as Milan, Greater Paris, Padua, Barcelona, showing that capital centers are now engaging in large-scale development. In short, the market is active, but opportunities remain far from exhausted. And this becomes undeniable when we compare existing and planned stock against the total potential demand. Even when combining existing units, beds under construction, and planned projects, supply still falls far short of the structural demand. This visual is the most critical data point for investors, and each bar represents the total potential demand in a major European market. The dark blue is the existing stock, medium blue are beds under construction, and light blue are the ones in planning. Stacked together, these represent the total known supply, while the beige section then highlights the missing beds. So we are not discussing just the marginal growth. This is about a structural continent-wide deficit. Student housing supply must expand significantly for Europe to reach functional saturation level. This means that for the foreseeable future, a well-located, professionally run scheme will attract immediate demand. So to conclude, our expertise is founded on quantifying the exact intersection of the discussed drivers. As an independent and unbiased research and market intelligence provider, we don't just collect and present the data, we help you navigate this complex, high-growth environment and translate insights into tailored, actionable strategies. And if you would like to explore the student housing market in greater detail, gain a free 7-day trial of our data platform, or discuss any project-specific or strategic support, we would be delighted to hear from you. So thank you all for your participation today, as well as for your questions in the chat, and we look forward to connecting at future events and continuing the conversation. Wishing you all a great day. Thank you.